Picture this. You're staring at a screen, maybe you're 23, sitting on your morning commute, just dreading that blank exam screen waiting for you at the test center.
Oh, yeah. We all know that feeling.
Right. Or maybe you're 38 on your lunch break and you're furiously trying to untangle a client's incredibly messy audit file. In both cases, the sheer panic is exactly the same.
Completely the same.
You're looking at a transaction and thinking, did the system update this automatically, or does this desperately need a human touch? And the answer isn't always obvious, but understanding that exact boundary.
Knowing precisely where the machine stops.
Exactly. Knowing where the machine stops and you have to take over is the absolute key to mastering computerized accounting.
It really is the ultimate dividing line between total clarity and just, complete confusion.
Yeah, 100%. So, welcome to our global audience for this deep dive. Today we're covering computerized accounting systems for the FA, FAU, and AA papers. Specifically, we're focusing on the recent syllabus changes regarding systems integration.
Right, it's a huge topic.
It is. So we're going to break this into 3 core parts, look at a detailed real-world example, and then finish with 3 exam tips you can use immediately. Let's unpack how the system actually divides this labor.
Well, the best place to start is just, the simplest possible definition. A computerized accounting system links specific business modules directly to the general ledger automatically.
Okay.
While leaving other business processes completely manual. Like, that is the core premise you need to hold on to.
So it's kind of like a smart home, right?
Oh, I like that.
Yeah, think about walking into your living room, a motion sensor detects you, and the lights turn on automatically. You don't even think about it, the system is integrated.
Right.
But for other things, like baking a pizza, you still have to physically walk over to the oven, turn the dial, set the temperature yourself. The oven requires a manual journal entry, so to speak.
That analogy holds up perfectly when you look at corporate infrastructure. And it actually leads to a reality that catches so many people off guard.
Yeah.
Cash and bank transactions are not automatically integrated.
Wait, seriously. The lifeblood of the business. The actual cash moving in and out of the bank account isn't automated.
No. Cash and bank are fundamentally manual processes in the context of these ACCA qualifications.
Oh, wow.
Yeah. The software doesn't magically know the cash has hit the bank account and then just update the ledger without human intervention.
Okay, so routine credit trading is the motion sensor light. It's automated, but everything else needs human hands. You have to go turn on the oven.
Exactly.
But why? I mean, if we're talking to the 35 to 44-year-old listeners who manage actual audit teams, why would a business deliberately leave its most liquid, high-risk asset as a manual process?
Right. Consider the alternative. Like, if an accounting system blindly assumed every single cash transaction was perfectly processed just because a receipt was generated somewhere.
Right, in the sales module or whatever.
Exactly. It would be operating on pure assumption.
Yeah.
Without a human manually reconciling the system's numbers against an independent third-party document, like the actual bank statement.
You'd have a disaster.
You'd be opening the door to catastrophic audit failures, phantom revenue, massive fraud. The integrity of the financial statements would just collapse entirely.
It would be absolute chaos. The control environment would basically be non-existent because the system is just trusting its own internal paperwork rather than the reality of the bank balance.
And this is exactly why examiners exploit this gap. There are 2 major reasons examiners love this topic. Here's the first. They want to test if you know exactly where that boundary line is drawn.
Ah.
They'll feed you a scenario and see if you mistakenly assume the computer handled the cash automatically.
Because computers might be incredibly smart, but they still can't physically open and count the petty cash tin.
Yeah, they don't have eyes on the physical world. They only know what they are explicitly told through their programmed modules.
Makes sense.
And the second reason examiners love this is the fluid terminology. Like, an exam question might use the words module, program, or system interchangeably.
Or just vaguely refer to the accounting system.
Right. You are expected to read through the jargon and identify the underlying mechanical process.
Let's break down those underlying processes. There are 3 parts to this. Let's take them one at a time, starting with the automatics.
Yeah, so part 1 focuses on the fully integrated processes. This is strictly your sales of goods and services on credit and your purchases of goods and services on credit.
Okay.
In these exams, routine credit trading is always fully integrated with the computerized accounting system.
Under the hood, though, what makes the system trust credit transactions enough to put them on autopilot?
It comes down to the master data. When a credit sales invoice is raised, the system relies on pre-approved, vetted variables. Customer credit limits, standard price lists, tax codes.
Stuff it already knows is verified.
Exactly. Because all of that data was previously checked, the system automatically recognizes the transaction in the general ledger. And at the same time, it updates the individual customer's account in the receivables ledger.
Simply put, routine credit trading is on autopilot because the system already knows all the rules of engagement.
Yep. Which brings us to part 2, the manuals. This is the territory of human intervention and manual journal entries.
The oven.
The oven, exactly. The primary areas here are non-current assets, bank and cash, payroll.
Which is fundamentally a weekly or monthly manual process.
Right, and inventories.
Wait, let me push back on that last one. I know for a fact I've seen exam questions that explicitly state a company's inventory system is fully integrated.
Oh, sure.
So if the prompt says it's integrated, shouldn't we assume it's automated?
See, that is a very deliberate trap. When an exam question specifies that an inventory system is integrated, it usually just means the physical tracking is automated.
Oh.
Yeah. So sales and purchase orders automatically check warehouse levels, and scanning a barcode at the loading dock replicates that physical movement in the system.
Which sounds completely automatic to me.
It is automatic for tracking boxes.
Yeah.
But the physical movement of goods does not instantly equal a financial realization.
Right, okay.
Even in an integrated inventory tracking system, the actual financial transfer of purchases to cost of sales and the period-end adjustments to the inventories ledger, those still require manual journal entries.
Ah, I see. A forklift moving a pallet is logistics. Updating the profit and loss statement is accounting, and that still requires a human to verify the period-end valuation.
The distinction is vital, and the same applies to payroll. You might have an automated clock-in system for employees.
Like a keycard swipe.
Right.
Ugh.
But those payroll reports are not automatically reconciled to the general ledger. A manual journal entry is still required to record the wages and salaries that were actually paid out.
Okay, so credit invoices trigger the autopilot, and things like cash, payroll, and period-end inventory are manual. But how does the computer actually know it's time to record those integrated credit transactions?
What do you mean?
Well, we established the system doesn't have eyes. What is the trigger for the system to say, okay, I'm doing the accounting now?
Oh, that brings us to part 3. Documents and matching. The system is programmed to look for a specific combination of documents.
Okay.
If the system performs what we call a two-way match, meaning it simply matches a goods dispatched note to a customer order, or a goods received note to a purchase order, that results in absolutely no accounting entries.
Because a delivery note just proves a box moved, it's a logistical check, not a financial one.
It merely acknowledges physical movement. It is the three-way match. When the system incorporates the actual sales or purchase invoice into that matching process, that triggers the automatic general ledger update.
That makes perfect sense from a regulatory standpoint. An invoice is a legal demand for payment.
Exactly.
Under IFRS rules, that is the exact moment a liability or receivable is actually born. So the invoice itself is the catalyst for the automation.
The three-way match verifies that what was ordered is what was received, and that the price on the invoice matches the agreed terms. Once those three align, the system acts.
So to bring that together, the system handles the invoices automatically based on that three-way document match, but it relies entirely on a human for the cash, the payroll, and the assets.
That is the architectural logic of the entire syllabus topic.
Let's ground this in reality. We're going to walk through a concrete, step-by-step global example. A business sells goods on credit to a customer, and a month later, they receive the cash. Step 1. The customer places an order.
Right, so a sales order is created within the sales module. The warehouse is notified to prepare the goods.
But in the accounting system,
The ledger remains untouched, no entries.
Step 2. The warehouse staff box up the items, load them onto a truck, and create a goods dispatch note, a GDN. The system sees the order and the GDN and performs a two-way match.
The goods have legally left the building, but we haven't officially billed the customer. The financial transaction hasn't crystallized. Still no accounting entries.
Step 3. The accounting staff verify the delivery and create a sales invoice in the module. Boom! The system takes the order, the GDN, and the invoice and performs a three-way match.
The automation takes over. The system instantly recognizes the sale, increases the trade receivable, and records the related sales tax in the general ledger.
Nice.
At the same time, it drops down into the detailed listing of customers and updates that specific customer's balance.
Autopilot is fully engaged. The system did the heavy lifting. But let's pause here for the audit professionals listening. In the real world, This three-way match isn't always flawless, is it?
Oh, far from it. What happens if the price on the invoice is slightly different from the original purchase order? Or if the quantity received is short by 2 units?
That breaks.
Well, real-world systems have built-in tolerance levels, but if a variance falls outside that tiny accepted percentage, the three-way match breaks. The system kicks the invoice out into an exception report.
And suddenly your beautiful automated process needs a human.
Right, a human has to investigate and manually override the system. Assessing who has the authority to perform those overrides is a massive part of a senior auditor's job.
That's a great nuance to keep in mind. But assuming the match works, the system records the credit sale. Now we hit step 4. 30 days pass. The customer pays their bill. Accounting receives a remittance advice from the customer saying, hey, we sent the money.
Autopilot disengages. As we establish, bank and cash are not integrated.
Right.
If you're early in your career, maybe starting your first accounting role or your first audit rotation, you are the human in this step. You are the one logging into the banking portal, pulling the internet bank statement, and manually verifying that the cash actually cleared.
And once you confirm it,
You process a manual journal entry to decrease the trade receivable and increase the bank balance.
you're the one walking over and turning on the oven.
Exactly.
Yeah.
And for the senior professionals listening, the managers, the directors, your job is designing the controls around that junior staff member.
To make sure they actually do it.
You have to ensure there is a rock-solid procedure dictating that a human actually processes that manual journal entry for the bank receipt correctly every single time. Because the system will not flag it if they just forget.
And that right there is exactly what the examiner is testing when they ask about the treatment of receipts from customers. They are testing if you know the autopilot turns off the moment the cash actually arrives.
We can look at the reverse scenario to prove the rule. Returns. Let's say the customer receives the goods, decides they're damaged, and sends a request to return them.
They just asked to send it back, so no financial adjustment yet.
Right. The warehouse eventually receives the damaged goods and creates a goods received note, a GRN, in the sales module. The system matches the GRN to the original sale.
Still no entries because we're back to a two-way match. It's just physical goods moving back into the warehouse.
Taking that a step further, the accounting staff then issue a credit note from the sales module. The system matches the credit note to the GRN and the original sale.
Because the credit note acts as the negative equivalent of an invoice, right? So it completes a new three-way match tied to the original transaction.
Yes. So the autopilot kicks back on. Automatically, the system recognizes the sale return, reduces the trade receivable, and adjusts the sales tax in the general ledger. The customer's individual account is updated.
Nice and smooth.
However, consider what happens if, instead of issuing a credit note to offset their account, the business issues a cash refund.
Autopilot off. Cash is moving. A manual journal entry is required to reduce the bank balance and settle the receivable.
The logic remains identical on the purchasing side. Purchase requisition, no entries. Purchase order, no entries. Supplier delivers goods with a delivery note, two-way match, no entries.
But the moment the accounting staff inputs the supplier's purchase invoice,
Three-way match. The liability is born. The system automatically recognizes the purchase, the trade payable, and the tax.
and when you finally pay that supplier 30 days later,
Manual journal entry.
we've mapped out the logic clearly, but there is a psychological track here that catches almost everyone out. I mean, from 20-year-old students to 40-year-old partners. And it's caused entirely by the smartphone in your pocket.
It is a fascinating metacognitive blind spot.
Huh?
Think about how you interact with money in your personal life. When you tap your card or phone to buy a coffee, your banking app updates instantly.
Yeah, I get a push notification that my balance has dropped before the barista even hands me the cup.
Exactly. We are deeply conditioned by consumer technology to assume cash is the most automated thing in our lives.
My brain is completely conditioned to believe that the moment money moves, the computer already knows about it.
But in corporate computerized accounting, especially under the strict rules of these ACCA exams, bank and cash are the exact opposite. They are not integrated. They require a manual journal entry every single time.
Wow.
You have to actively unlearn your consumer habits when you walk into the exam room or when you're auditing a client's system.
The fix is simple, though. Always completely separate the concept of credit from cash in your mind. Credit is automated. Cash requires manual bank reconciliation.
Yes.
When it comes to cash in these exams, just pretend the accounting system still lives in 1995. Someone has to sit down with a paper bank statement, a highlighter, and physically type the numbers into the ledger.
Pretending it's 1995 is a very safe assumption for exam purposes. And, you know, that same level of manual caution applies to non-current assets.
Let's talk about that. I imagine buying a massive factory machine throws a wrench into this whole system. It's not a standard inventory purchase, so the regular three-way match autopilot wouldn't work. How does the system handle an anomaly like a major asset?
It doesn't. Disposals and purchases of non-current assets are entirely manual processes. If a company sells a piece of machinery, the accounting staff manually issue a sales or disposals invoice.
Right.
You do not put it through the standard sales module because, under IFRS accounting standards, it is not a standard sale of goods.
Because feeding it into the standard sales module would artificially inflate your regular revenue figures, right?
Exactly. It would distort the financial statements. Because non-current assets are not integrated, a manual journal entry must be processed.
So you have to manually update the trade receivable or the bank balance, manually adjust the non-current asset cost, and accumulated depreciation.
And manually calculate the gain or loss on disposal. And most importantly, someone has to physically update the non-current asset register.
So buying a delivery van operates on the exact same logic. You manually recognize the asset using the purchase invoice. You keep it far away from the standard purchases module to protect your cost of sales figures.
Right.
You process a manual journal entry for the payable and the asset cost, update the register, and then manually set up the depreciation schedule.
The overarching theme is that anything outside of routine, repetitive inventory trading requires human judgment and manual entry.
Okay, let's turn all of this into practical ammunition for the exam. 3 things. Here is number 1.
Look for the word credit. If the scenario describes a routine credit sale or a credit purchase of goods or services, it is fully integrated. Everything else, cash sales, cash purchases, payroll, requires a manual journal entry.
Got it. Number 2. Two-way matches do not create accounting entries. Only three-way matches will update the ledger.
If the system is only matching a physical movement document, like a goods dispatch note or a goods received note, to an order, no financial liability has crystallized. It's the introduction of the invoice that triggers the automatic update.
Perfect. And number 3. Never put non-current assets through the standard purchases or sales modules.
Disposals and purchases of non-current assets are strictly manual journal entries to comply with proper financial reporting standards. The non-current asset register must also be updated manually.
Routine credit lives in the module. Everything else needs human hands. If you are studying for your exams right now, take a deep breath. You now know exactly what the computer can and cannot do. There is no more second guessing where the boundary line is drawn.
And for the experienced audit professionals, keep your focus on the risk. Design your manual controls around the cash, the payroll, and the non-current assets. Do that, and the system will safely take care of the routine credit on its own.
So think back to that cold open. No more staring at a blank exam screen or a messy client audit file in a panic. You don't have to wonder where the machine stops and the human begins anymore because you understand the mechanics underneath.
Exactly.
Systems automate the credit invoices, but humans must manually journal the cash, the payroll, and the assets.
That's the golden rule.
Thank you to our global audience for joining us on this deep dive. If you found this breakdown helpful, please follow the show on Spotify and leave us a review. It really helps us reach and help more learners. Thank you for listening.